The 1031 exchange is not a loophole. It's a savings enhancement that also allows people more discretion in terms of timing their own exposure to capital gains.
Hey everybody, we want to give you a preview of what's going to be coming up in episode 261 of the Real Estate Rundown. I'm going to be interviewing Mark Hamilton, and in this episode we're going to talk about the value of a 1031 exchange and what that means to accumulate real wealth in real estate and how you can use that as a personal financial savings strategy, plus all the ins and outs of multifamily investment. So you're going to want to tune back in. Mark's going to talk to us about how he has grown his company, Hamilton Zanes, for over the last 20 years and how they specialize in multifamily investments and what his passion is for a 1031 exchange and why that's something you're going to want to know. So if you're looking to learn about 1031 exchange and how to use real estate investing to build your personal financial savings, you're definitely going to want to tune into this next episode of the Real Estate Rundown.
Welcome to the RobNet Real Estate Rundown podcast, where Shannon RobNet has handpicked industry experts to discuss all aspects of investing in the real estate world and seeks to help all real estate investors improve their education and their proven strategies to grow their real estate journeys. Now, here's your host.
Hey everybody, welcome to the Real Estate Rundown. Today I am interviewing Mark Hamilton. Mark, how are you?
I'm good, Shannon. How are you?
I'm doing well, sir. Thank you very much. Hey, so I understand that you've only been doing this for 20 years. And so with that, right? Anybody that's survived in real estate for more than about 4 years is getting close to a career, and anybody over 15 is legendary, right? Because there's so much that goes on in real estate that people just don't survive. But
it can have a short life cycle for some, that's for sure.
Yeah, but in your career, you've developed almost 40 properties in the Bay Area. Your main focus has been on locating value add to change urban neighborhoods. You've been working with high quality buildings with high income tenants, improving traffic profiles, higher resale values, but you've done that with specific tax strategies involved. So Mark, kind of tell us a little bit about how you got involved in the real estate space, and then take us to the place where your company is today and what your passion is.
Sure. Well, thank you. So my career really kind of exists in two halves, not quite halves, but let's just pretend they are. From 1985 to 2001, I really specialized in the close-in Bay Area of Northern California, mostly San Francisco and Oakland, but also invested in a few other communities, some of the other suburbs in the Bay Area. So that was between 1985 and 2000. And I did about 40 projects over those 15 years. Starting in 2001, I became partners with Tony Zans, who was also working some of the same markets that I was. And since 2001, we've acquired about 215 multifamily communities, eventually throughout the United States. We started on the West Coast and then just gradually went east. But in the first portion of my career, I really started using the 1031 exchange in the 90s. And then since Tony and I formed Hamilton Zans in 2001, probably 80 to 85% of our acquisitions have had exchanges involved. And given the way we structure them, which is really one of three ways, either as a separate account for a high net worth individual or in a Delaware statutory trust configuration. But most of our transactions have been tenant and common structures. And so, with those, there could easily be 10 to 15 exchangers in one of those transactions. And as such, we've literally facilitated 2,000 to 3,000 exchanges in our property acquisition. So it has been an important driver for our business.
So Mark, let's back up for those of my listeners that aren't quite familiar with it. What is, when you keep talking about an exchange, and you and I, we know it as the exchange, but what really is it? What's its formal name, and what is it really designed to do?
Okay, so a 1031 exchange refers to the section of the tax code, section 1031, and it requires something that can be defined as a like-kind exchange, which means effectively selling or relinquishing is the term they use in the code, a piece of property, a piece of real estate, real property. It can't be personal property or securities or one thing or another. But you dispose of that, you put your funds with an exchange accommodator who's most specifically not you. If you take the funds yourself, that's deemed to be constructive receipt, and your opportunity to do the exchange has just vanished. But there are all kinds of qualified intermediaries who work in this trade and have it down to a science so that it's fairly simple. And then once you locate a property you wish to purchase, then you instruct the intermediary to wire those funds to escrow. And in the simplest terms, the investor's burden is this: take all of the equity that you got free of the property that you sold, reinvest all of that or more in a replacement property. That's one piece. The second piece is look at the financing balance that you had on that asset and replace that balance, obviously with a new loan, or more in the property that you purchase. And if you do that and follow the other protocols, you will complete a 1031 exchange, which allows you to defer the gain that you would otherwise have paid with that sale, and probably the recapture also, and defer that until a later day. It might be upon the disposition of the replacement property. You could do another 1031.
Right.
And in our research, we authored a paper that I thought the team did a terrific job with, that was co-authored by CBRE, the 10 public policy benefits of the 1031. I mean, it's widely characterized as a loophole. We think that that's less than fully accurate.
Absolutely.
And we say that in part because most people, 85 to 90% of people who do an exchange, they may do another one. They may even do a second one. But 85 to 90% of people, it's a temporary strategy for them to time their exposure to capital gains. And again, 85 to 90% of the time, people will liquidate. And as such, the public treasuries actually make more money.
I couldn't agree more. I mean, it has a bad rap. It's something that people say keeps the wealthy wealthy. And yet the reality is we're buying into something that needs repair, something that needs to have some value added. Very rarely does somebody sell something that is a cash flowing asset and exchange it for a very similar cash flowing asset. Typically, one will take an asset, bring it up in value, like you've done throughout your career, value add, take it from a C- property to a B+ property, capture that value, turn that to someone else who just wants to collect coupons and get checks in the mail, and then move that money into a new project that is now a C- that you're going to convert to a B+ on the next one. And so you're really transacting to continue to improve. And the reality is, if you're going to pay 20% of your profits as a penalty for selling, most people won't.
Yeah, you raised two really good points there. First of all, again, the data that we relied on for this paper, the data are clear that when an investor does a 1031 exchange, the net spending that the investor does on the property is significantly higher than when an investor simply pays cash for a piece of property. And so, we relied on information in a fairly well-known academic paper called the Ling-Petrova paper that was authored, I believe, originally in 2015 by Professors Ling and Petrova. They updated it recently, but their information is compelling. And again, net spending on assets, job creating spending, spending that purchases materials that create sales tax is all much higher when someone does a 1031 exchange. Yeah. And the other thing, to your second point about investor mindset, do I want to do a 1031 exchange, or do I just want to be left alone because I'd have to pay the capital gains tax. There's another compelling data set, and it is this, that 6 out of 7 people who open an exchange account, obviously completing a sale, intending to do the 1031, 6 out of 7 of those investors never complete their exchange.
Wow.
However, they sold the property anticipating that they would. So we think that creates liquidity in the markets. We think it creates transactional velocity. And because those 6 transactions took place, cities and counties made transfer taxes that they wouldn't have otherwise made. And, I think you and I could probably agree that those cities and counties liked having that tax income. And because I haven't heard too many of them complain that they have too much tax income.
Right. I would have never honestly guessed that I would have never guessed that a simple majority weren't completing exchanges, let alone 6 of 7 not completing exchanges. That is extraordinary. Was that a wide date stamp, or was that lately because of the heat of the market, or is that over the last 15 years? Is that
we learned about that from one of our joint venture partners, one of our New York joint venture partners, about 2 years ago, and this particular institution is tied very closely to 1031 activity. Right. So we thought their information ought to be reliable, but sure. I think that data, I'm just going to guess and tell you that data set probably covered, preceding 3 to 5 years.
I would think so. But I'm a little bit flabbergasted at that being that high. But there again, it got the ball rolling. What they chose to do with it is up to them, right?
Yes.
So.
But again, we think that creates that the public treasuries, especially the IRS and any state taxing agencies, are better off because those 6 transactions that didn't complete resulted in a harvest for them of taxable revenue that I would argue they might not have had.
Absolutely. So Mark, you mentioned a lot about partnerships and people that you're working with and all of those kinds of things. Tell me a little bit more about how you and Zans structure your deals.
We come downhill. I like to refer to us as an overgrown backyard syndicator, because that's what our roots are. Our roots are friends and family, and it's always been that case. We've never taken an investor that we didn't know or didn't get to know before taking an investor. We follow the safe harbor of Reg D as a securities issuer, and that requires us to do a variety of things, including getting to know the investor. So we make sure that it's somebody we know or have come to know, and have been able to establish for ourselves as much as possible that it's going to be suitable for them, and then we simply notify our clients what we're working on. We're generally always working on an acquisition, in part because we always pretty much have our own 1031 exchanges going on, and we need to get them, completed. But we'll notify people, and then and we work with accredited investors, and so between our accredited investors that we stay in touch with and any friends, family, colleagues, or referrals who we have who need to complete their own 1031 exchange, we're always kind of in the process of firming up capital availability, and we're constantly looking for new opportunities. And that's probably 80% of our business. We are a joint venture partner with a significant New York firm on their DST platform for multifamily. So in those instances, they raise most of the money. And we've also done probably 30 to 40 transactions with institutions, some of which are household names. But we're usually going to follow, one of those 3 strategies. Sometimes we'll meet a family or a high net worth investor that needs their own solution. Right. And so in those cases, it's usually just us and them. We won't put other investors in those. But we have a few different strategies that we follow. And, in ancient days, when you were probably still riding a tricycle or before. Um, we were doing rough stuff, or let's just say rougher stuff in San Francisco and Oakland, and most of it was property that we could see daylight in, that it needed a lot of heavy lifting and a lot of tough love, and so it was very heavily about a renovation business, and over the last 35 years, it's evolved to, we still do some of that. I mean, we'll still do plenty of value add or heavy lifting on projects, but I'd say it's more balanced now, and we have probably 40 to 60% of our acquisitions in any given year are going to be what we would call core plus. It means
Right.
they're newer, they don't need as much heavy lifting, and they're really intended to be more of a long-term cash flow and growth mechanism rather than primarily growth.
And it's funny. I want to back up here because you said that you are a overgrown backyard syndicator. Mark, I don't think that's accurate. The number I have here is that your acquisitions are just over $4 billion. Is that an accurate number? So
well, actually, it's not.
Actually,
It's all right. So actually, it's not, because we just passed the $5 billion threshold.
Oh, right.
And,
yeah.
Yeah. So, I mean, I use the word overgrown advisedly. But maybe it just comforts me to think about us as, the kids from the block. But yeah, we've done a really good job growing the organization, growing the portfolio, and helping investors achieve good returns. And it's worked out. And, we've never fed it artificially. We've never taken an investor into the business entities. And it's just been a gradual, one day at a time approach that has taken us or taken me, I should say, from 2 units to 23,000 units.
Sure. And so you can very clearly state that that you have become an overnight success 20 years in the making, right? I mean, I would think that's about as accurate a description as your overgrown backyard syndicator description of the size of your business, Mark. I mean, and then because you like to do the 1031 exchange, because you like to churn the property, how often does that $5 billion turn over? Are you turning that portfolio every 4 to 5, 6 years? It's
a really good question. Yeah. So back in the 80s, we were probably holding things 1 to 3 years. And then by the early 2000s, life cycle of a transaction was probably more like 2 to 4 years. Half a dozen years on, it was probably more like 4 to 6 years. Where the holding period of the properties in our portfolio has lengthened considerably over time, and that doesn't necessarily reflect ideology, although we are trying to take longer term positions for sure. But let's face it, cap rates have tumbled. The market is awash in capital. And if you think you're going to find something that's going to allow you to double or triple your money in 3 years, I want to know your pharmacist.
Right. Well, and it's funny you say that too, because, all of those things are correct. But then the one thing that I heard you say was the quality of the deal you're going after. Instead of seeing something that is a D minus, trying to get it up to a C plus or maybe a B minus, you're going after core plus, which is a better asset class that weathers storms better. You've kind of stepped up your game out of the backyard to, buying and acquiring better properties that you would want to hold longer, because you're not just, not that you ever did a fix and flip, but, the heavier the lift, the easier it is to make the money quicker, because of all of the expertise that you're pouring in, instead of core plus, where you're getting something that, maybe some paint here, some new management there, some policies and procedure changes that really bring that value up. Am I kind of going in the right direction here? Where you've gotten?
Absolutely. We like a value add deal as much as anybody, and at
you
any
make it
given
sound
time,
like a guilty pleasure, like eating a cheeseburger or something.
No, but I mean, that's everybody's first date, right? That's everybody's first
right.
love as a value, as a value add deal. And, at any given time, we probably have 75 to $100 million of projects going on our portfolio. But on an average basis, we're, as you said, we're buying better right now. We're buying better assets. We're buying properties that we can hold longer. And I think that that's probably equally due to having a number of positions that we've grown hard over lifespans as long as 20 or 30 years. I mean, I literally still have partnerships that I put together in the early 90s. And, those positions have grown phenomenally. But curiously, people get to a point after after some number of exchanges where they literally say, do we have to keep doing this? Can't we just hold something and take the cash flow? And so, we're getting more of that, so we're getting our duration is getting longer because of that. But again, the other thing is, we were never much of a C- player. We probably dabbled in C+ to B- a bit. But there's just so much capital in that arena that it's hard to get things that we think are priced for the for an investment thesis that makes sense. They're just, returns are really compressed.
They are. And there's a lot to be said about that, the value add space getting more and more crowded, and being able to level up your game and go to a different level. But and I often make the comparison between myself and my investment strategy and my father, who is at that place where he's got the lumps, he's got the battle scars, he's done the deals,
Sure.
He's got the trophy.
Yep.
Now it's about cash flow and motorhome fuel, right? It's about enjoying life, to do the things that you want to do. And an exchange is work. Every time you're doing an exchange and every time you're taking down another property, your investors aren't seeing it, but there's a whole machine behind that you've had to create that has turned that into there. But you use it to build financial savings. Tell me how your particular brand, the Hamilton Zands brand, is building the financial savings thought process in your investors, because that's not a term I've heard before. And I just want to drill into that and make sure that we can extract that for my listeners as to what you're building.
Well, thank you for that point. I do think that, and I won't tell you that I came up with the term. It was in our paper. It was coined by one of the other staffers in our organization. That the 1031 exchange is not a loophole. It's a savings. It's a savings enhancement that also allows people more discretion in terms of timing their own exposure to capital gains. And again, between the two data sets, we know that 80 to 90% of people will not be in many more exchanges than just 2 or 3. So that's going to expose that money to the taxing authorities, right?
Mark,
I'm
laughing real quick because most people aren't involved in more than 2 or 3, but your organization alone has swung that data so far the other way because of the number you guys have been involved with. How many exchanges did you say you'd been involved with?
Well, if back in the early 2000s, with CMBS loans, you could put as many as 35 different people on title. And so we had, we had easily a dozen transactions where we might have had anywhere between 15 and 35 people on title. When the CMBS market got strained and it became, really an agency universe, initially the agencies didn't want to have more than 5 people on title, but we're able to work with them and get, generally 10, sometimes maybe a dozen people on title. But if you count each one of those as an individual exchange, which I promise you, everybody's CPA and the IRS will tell you that each one of those is an exchange.
That's right.
We've probably done an average of 15 exchanges, 12 to 15 exchanges on 210 to 220 acquisitions. So, it's a material number, but again, those people, I cannot tell you that those people don't eventually pay their taxes. They do. No. A lot of them will eventually take their chips off the table. They may have other reasons for, they'll have other reasons for paying their taxes, but they're able to time it, right? And along the way, by doing the exchange, the real estate industry has, by virtue of that, has caused more people to spend more money on asphalt and roofs and siding and windows, which is taxable sales almost everywhere, and has caused contractors to have more business and make more payroll tax. And then in the end, 80 to 90% of people will simply choose not to do an exchange. And on the ones that do, 6 out of 7 won't complete it because they can't find something that feels quite right. So we think it's already a very efficient tax mechanism, and that, throwing the baby out with the bathwater could hurt cities and counties and maybe even states.
Yeah, no, and you bring a different mindset to it, or a different thought process, because, with all the data that you have, and that's the thing that I love when I get the opportunity to speak with professionals like yourself, is you really get to the data behind the thought process. And everybody likes to go, well, this and that, but when you really drill into the data, that there are so many that are done that don't get properly executed or finished, that really does lead to a lot of tax revenues. Plus, like you said, there are very few people that continue to exchange indefinitely. At some point, those tax dollars do come due. There's a few that may fall into the inheritance that gets leveled up on that, as far as through that inheritance process. But most, there comes a point when you can't go any farther. You have to pay the taxes, and that was always the thought process behind the IRS saying that we'll get our taxes eventually.
Yes.
And Mark, we're sitting here in a place in history where, while it may be contemplated as to what happens to capital gains tax, we know that it's never been less. So when you have something that has never been less in history, the capital gains tax is 18.5%, I believe, on the federal level.
I would have said 20, but go ahead.
Yeah, you're right, 20%. So at 20%, why is it that you guys feel that so strongly about the 1031 instead of just paying the taxes now, moving into different administrations, bringing on different thought processes? Because eventually you are going to pay it. Wouldn't you just pay it currently?
Sure. Well, for one thing, that's not our shot to call. It's up to the individual investor. Yeah. And for people who are invested in our partnerships that participate in exchanges at the partnership level, again, anytime we sell one of those assets or have a capital event, some number of that population will take chips off the table and pay their taxes. So I really do think that it's a timing mechanism.
Yeah.
And the data is there that people, you don't hear a lot of people crying in the streets saying, I'm one of those 6 people who didn't get my exchange completed, right? Or
I've never heard about them.
Yeah, I'm one of those 85 people that decided not to do my exchange, right? It happens quietly. People time it as they see fit. Nobody's crying over spilled milk. If they don't get it done, they move on. And that's clearly at least in the current in the current paradigm, which has been in place for 100 years, that's the prerogative of the taxpayer. So, we don't make those judgment calls. We know how to go about doing our work in a way that's favorable to the investor. And we believe in creating long-term savings. We're net investors every year in the portfolio. And we've just seen the benefits of, you might call it kind of cookie jar money, just making sure you're always stashing some money in that cookie jar.
Right.
And if you're putting that into good things, you ought to have an increasing stash in your cookie jar every year.
Right.
But, we think that's up to the individual investor. But we also think that back to the data, if you and I bought a property together, and let's say we spent $1 million on it, and it was $250,000 down and a $750,000 loan. And, it turns out we pick a winner, right? And now we discover it's worth $2 million and still only has a $750,000 loan. Well, that means that our basis has stayed the same. The amount of investment money that we put in fact, our basis has probably gone down through depreciation. So our basis might only be $200,000, but now we're sitting with $1,250,000 in equity. Well, guess what? That the income that drives that equity is more exposed to taxation than the basis was on the first go round. So by completing an exchange and growing your investment account, your capital account stays the same or probably goes down, which means that the income that your up-leg investment is producing is in fact less efficient as a tax shelter than it was on round one. So, again, we think of this as kind of, it's a whipping boy in Washington.
Mm-hmm.
We think that if people really dove into the numbers and looked at the economic impact and the tax favorable impact, I think people would see it differently.
Yeah. That's a great point. So, Mark, what is it that you would give people advice for, having done so many 1031s and seeing the number of people that fail at that? What would be the one piece of advice you would give someone to make sure that you're successful at a 1031?
That's a really good question. And a lot of it depends on size, right? I mean, anybody who has the savings to do it and has the time can go out and find something. It's hard to do, but to go out and find something that has the appearance of being a good candidate for a successful real estate acquisition. And so, I think the first thing you got to do is you got to address the scope of the exchange or of the acquisition that you want to target. Is it a $250,000 house? Is it a $2.5 million apartment property? And so you got to size your war chest accordingly, and then you also have to think about what kind of transaction opportunity you're going to have.
Mm-hmm.
Because if you want to buy a $250,000 fixer upper, and you're in the Boise housing market, which is on fire right now, and you can't even touch a wreck for $500,000, well, you need to reassess. But you can do an exchange, you can do an acquisition on your own, you can do it in a partnership with friends or family. You can invest with sponsors like us. A REIT, investing in REIT stock won't get you there because that's stock. You're buying stock. But I'd say, suitability is the most important thing. Are you suitable for doing real estate investment on your own? Do you feel like you'd be better off throwing your lot in with some friends or family? Do you feel like you'd be better off throwing your lot in with a sponsor? So, you got to decide your target first. And then you also have to be comfortable being in a liquid investment that may call for some heavy lifting at times. You might be in Austin, Texas, and you might have a great fourplex, and a big thunderstorm comes through and rips your roof off. Right now, if you've arranged your insurance appropriately, you'll be fine. But there's still brain damage that
Yes.
has to be absorbed.
I think, Mark, you're giving us something from your past experiences with being in Austin, Texas. I was just down.
Been there.
Was just down that way last week, and they were having some severe weather. So yeah, it's interesting too. How that goes into it. Everybody thinks that Chef Tony invented real estate. You set it and forget it, but there's still a lot that goes on with that people forget.
No question.
Being involved with someone that's done has $5 billion in assets. Best guess, what do you think the total transactional number is?
For our shop?
Yes, sir.
We've acquired approximately 210 to 220 apartment properties at Hamilton Zands in the last 20 years. We don't include the tally of my portfolio before that, or Tony's tally from his portfolio.
Let's not date everybody and look too impressive.
Well, yeah,
where the average man can get their hands around it.
Yeah, we're not gonna blow it up with those years. So we've done about 5 billion, 200 million of acquisitions in the last 20 years. 200 and let's just call it 210 properties, 220 properties. We've sold about 110 properties as well. But again, when we sell, we're almost always going to go do the 1031 exchange. And right now, our portfolio probably sits at a valuation of about $4 billion. And we're buying more this year. We've already closed between what we've closed and what we have in the pipeline. We're already about. I think we'll close the third quarter at about 500 million in acquisitions
for the year.
I think
not too shabby.
There's still another quarter to go. No, yeah, it's working. It's hard work right now because it's just so competitive.
Yeah. So having been in the industry what in a lot of people's would be 3 or 4 lifetimes of real estate, because like we discussed earlier, they just don't last. What would you tell your younger self?
Interesting question. That's a really good question. I don't know that my first 15 years would have been that different. If I had reached out from the future and said, do these things differently, I don't know that they would have been that different. And the last 20 years, I think, it comes down to very basic things. It is a one day at a time business. It doesn't pay to get ahead of yourself. And at the same time, you have to be willing to push yourself. And, once upon a time, and I think 2004, Tony and I had 2 acquisition opportunities. One was 4 million and one was 5 million. And, we were just getting to the size to be able to do that. And he was concerned that, that we were going to have to pick between the 2. And I just felt really confident that we were going to be able to do them both. And so when he said, which one do we want to do? I said, well, let's just do them both. We can do it. And, if you're getting in front of your own audience, if you're taking investment capital from friends and family and you're staying close to the work and you treat it as a one day at a time thing, your chances are going to be really good. And, I guess that's probably the advice I would give, is that, you take it one day at a time and you try not to get too tied up in the highs or the lows.
Right.
And you just keep going. You're probably going to have an easier time of it. Because when I started, when my wife and I bought our first property in 1985, we were both 27, and it just felt like, each individual transaction was the entirety of the world. And, that everything about the future was going to come out of one transaction. And guess what? They didn't. They came out of all of them. Right. And that happened because we just stayed with it.
Yeah. No, consistency has a lot to do with it for sure. But, Mark, you are probably the first person in 260 interviews that has told me that real estate is a day by day deal. And, when I think of it, I look at what you're doing today and how that builds on tomorrow, but it has no carryover. Tomorrow you start over, right? What you did today left in today, and that transaction is closed or it's walked away from, or it's a lot of things, but you've got to start over tomorrow and prove you can do it again.
No question.
So I really appreciate you stopping by the Real Estate Rundown here, Mark, and just giving us some of this insight knowledge. We don't often get somebody of your caliber here that is so open, that is just able to just be as transparent as you have been. I really do appreciate it. So for my listeners, though, where can they reach out to you in the world and find you and follow you and become more acquainted with your company?
So we have a pretty good website, Hamilton Zands. It tells the story well. It's very user friendly. It's easy on the eyes. It's easy to take. And it just reiterates a lot of our basic ideology, shows our footplate, gives a overview of the company. And then otherwise, my email address is Mark, M-A-R-K, at Hamilton, Hamilton, Z as in zebra, A, N as in Nancy, Z as in zebra, E as in Edward.com. Wow. You won't find me on Facebook. You won't find me on Facebook or Twitter or Instagram.
But you guys, I just got you an email address from a superpower executive, guys. So thanks for tuning in, everybody, to this episode of the Real Estate Rundown. Mark, again, I want to thank you. Don't forget to like, share, and subscribe to the Real Estate Rundown on Podchaser, Spotify, iTunes. We are on Facebook. We do have our Instagram account. So follow us there. You'll see the updates. You'll see Mark on there. We appreciate you guys. We know that this show is about you guys and bringing information to you. So leave a review. I love to hear the feedback. And Mark, once again, I really appreciate you coming by and giving us this knowledge. It has been super, super helpful.
You bet, Shannon. Thank you so much. I hope we have a chance to talk again.
Absolutely. Thanks again, Mark.